Market shakeup between new geopolitical tensions in Iran, tariff uncertainties, and fears of an AI bubble burst. The stock has been on shaky ground lately. So what does it mean for your savings? And for those of you nearing retirement? Well, joining us now to help us make sense of it all is local financial professional Stuart Fields. Stuart is with Open Air Advisors. Good morning. Thanks so much for joining us, Stuart.
Good morning.
Well, let's dive right in. Tell us why the stock market is so tense right now.
The stock market trades on news, and boy, has there ever been a no shortage of news in the market lately. So you mentioned a couple of things earlier, tariff uncertainty, of course, the conflict in Israel, stock market correction due to AI stocks. So conflict of Iran, basically the moment this all started, we saw an initial plunge in all of our indices. The S&P 500 was down 2%, the Dow was down 3%. We had tech heavy NASDAQ down 1.2%. But after that initial drop, the indices recovered. A lot of people were buying the dips, kind of increased our markets back up to kind of the all-time highs that we're at. But now again, the markets have suffered. And a lot of it's pointing to a lot of tariff uncertainty on top of this. We've seen the Supreme Court rule the Trump tariffs unconstitutional, but there's some clearer path to enact similar things to increase import costs. So they're looking at the Trade Act of 1974, for an example, which does give the administration the right to increase tariffs by 15%, but only up to 150 days. We do see this conflict going on for at least 4 to 5 more weeks, and that was Trump's words here recently. So the longer this carries out, I think the more price constraint that puts on our markets. 20% of our oil goes through the Strait of Hormuz, and as long as there's a conflict going in those waters, we could see oil prices continue to surge. Oil prices increased over $90 a barrel, which was a 35% increase week over week, which is the biggest we've seen since 1985. And on top of that, we have a stock market correction. We have AI stocks leading the charge once again. Last year, 80% of our growth was due to AI stocks. So many people are wondering, does this sound familiar? Does this sound like the early 2000s dot-com bubble? Maybe. A lot different this time, though. Back then, many of those companies were hollow, startup companies that you've never heard of, fly by night. Today, these AI companies are well established. They have profitability records. They have strong business models. So the companies this time around are much more stable than the many weaker dot-com companies that led to a lot of panic selling and made a lot of investors nervous back into the early 2000s.
Mm-hmm. Yeah, and we know when we talk about investors, some people might think, that doesn't apply to me. But if you're investing money into a retirement account, that directly applies to you. So whether it's a retirement account or a high yield savings account, how can people today begin to manage their financial risks during times like these?
Yeah, first of all, I would say diversified. Diversification is one of those things where people are forgetting about because, as I mentioned earlier, AI stocks up 80%. It's going to be easy to gravitate towards that. But this year in 2026, diversification has worked. So look at other sectors like energy, consumer staples, healthcare. Diversified portfolios have overperformed a little better this year versus staying very, very heavy into the Magnificent Seven stocks. Remember to rebalance. When we're looking at rebalancing, a lot of your portfolios have done well over the last 2-3 years, maybe even decade. And so over time, your portfolio drifts and your portfolio will drift to be more aggressive. And so during uncertainty, when the markets go down, you may lose a little bit more than you expected. And again, work with a professional. A lot of these topics, a lot of these decisions are very intimidating. So ask your advisor. No matter if you're conservative, moderate, aggressive, stats show that working with an advisor who's going over these things, including your tax situation, can increase your return by about 5%. So again, don't be afraid to ask questions, reach out to people. There's been a lot of news going on. So the more news you have, the more information you have, I think the better position most clients will end up being.
Absolutely. Lean on those experts. Great advice, Stuart. Thanks so much again for joining us this morning.
You're welcome. Thanks for having me.